The Reserve Bank of India front-loaded its rate hikes with a 50 basis point repo increase on Wednesday, as it expects retail inflation to stay above the 6% tolerance level for 3 more quarters. While the markets were expecting a rate hike between 25 and 75 basis points, the Monetary Policy Committee's pitch for a high number indicates that more hikes might be coming. In the fixed income market, the yield on the 10-year government bonds retreated to 7.49% on Wednesday, only to climb back above the 7.5% mark on Thursday. The whipsaw in bond yields reflect the nervousness in the bond market, given a considerable policy tightening expected from the US Federal Reserve and the RBI. According to Vivek Kumar of Quantico Research, 10-year GSEC yield could crawl to 8% over the next few months, before moderating a bit by the end of FY23 on the back of moderate fiscal consolidation in FY24 and most central banks approaching peak in the respective hiking cycle.
The forecast of uncomfortably high inflation of 6.7% in FY23 is bound to increase the urgency for withdrawal of policy accommodation. And this is happening in a time when the global environment is completely hostile. Most of the key central banks are pretty aggressive in normalizing their own monetary policy rates in their economies. Our own in-house expectation is for a 75 basis point further increase in repo rate, along with the possibility of another 50 basis point increase in the CRR. This, we believe, will push yields up, with the 10-year rate expected to trade closer to 8% before the end of the financial year 2022-23.
Edelweiss Securities, meanwhile, expects the 10-year bond yield to hit a peak of 7.75% as the RBI intends to ensure an orderly conduct of the government's borrowing program. Given this, the brokerage expects the RBI to resort to open market operations to calm the GSEC market. Nonetheless, higher bond yields could shift new investors towards these relatively safe asset classes, while higher interest rates could affect corporate profitability. As a result, equity valuations may be eyeing downgrades in the near term.
So on downside, maximum Sensex can go to 52,000 points. That's about 2 to 4% fall can happen in both Sensex and Nifty if oil fails to correct from the current level. Because both RBI and even US Fed, they have not crossed the midway of rate hike. It's only a beginning of the reversal of monetary cycle. So normally, the market discounts well in advance. So for the market to discount the difficulties coming to the liquidity in terms of rate tightening is not yet started. It will start perhaps after the monetary authority at least fulfill 50 to 60% of the targeted rate hike. So that could happen in the next 2 to 3, 4 months. After that, it all depends upon the oil price. Because my fear is that the Ukraine war may go on for throughout 2022 also. That is also possible because we see a change in the strategy. After 100 days, they have captured only 20% of the total area in Ukraine. So they may opt for marginally incremental encroachment in Ukraine, and therefore the oil might continue to be under pressure. And if oil goes to above $140, then even after 2 months, the market Sensex may not recover and it may settle around 52,000 points. But on the other hand, if oil corrects below 100 by end of the year, you can see anywhere from 62,000 to 65,000 Sensex range, which would be minimum 10 to 12% return from the current level.
Analysts suggest investors stick to low debt businesses, invest in funds having maturity of 2 to 3 years, or dynamic bond funds.
First of all, don't borrow money and invest. If you have a borrowing also, don't make a fresh investment. Try to pay off the borrowing. And within equity corpus, try to have a 5 to 20% cash within the equity. That is my research strategy, I would suggest, because the pain is not yet over. It may continue for 1 or 2 more months. and to some extent one can bet on the value stock which provide high dividend yield. So last 10 days we see that some of the stocks which pay dividend yield of 5% or above, they started seeing some bottom, because investors will not offload such stocks even if market falls further, because even instead of putting money in the bank, they can get a better return from the market. So that can be one strategy. The other strategy could be to have a tilt towards Nifty stocks or top 250 stocks, because the DIA support is normally around index stocks, and that would give some comfort.
On Friday, the European Central Bank's interest rate decision and the US jobs data will be some key factors driving the markets. That apart, Brent crude prices, rising COVID-19 cases, and the US inflation data will also be on investor radar.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
तुम इतना डर गए?
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and reporting with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.